Did Washington deliberately crush Japan's rise to global superpower status? In the 80s, Japan was unstoppable, its economy a terrifying titan poised to rule the world. Then the Plaza Accord, a shadowy US-led currency ambush that sent Japan's miracle economy into a death spiral from which it has never truly recovered. Coincidence? Or a brutal, calculated takedown to maintain American dominance at all costs? As Japan still reels in 2025, decades later, we expose the shocking truth behind its lost empire and the iron fist of US economic warfare. Japan's post-war miracle. To understand America's alleged motivations, you have to appreciate the sheer, terrifying scale of Japan's post-World War II economic resurrection. It was nothing short of a miracle. A nation utterly devastated by war, with its cities in ruins, transformed itself within a few short decades into an industrial and technological colossus. How did they do it? A potent combination of factors. A highly educated and disciplined workforce, brilliant industrial policy orchestrated by the powerful Ministry of International Trade and Industry, the supportive keiretsu system of interlinked corporations and banks, an export uber alles economic strategy, often described as Yushutsu Shiko, or export prone, and an almost religious devotion to quality control, and continuous improvement pioneered by figures like W. Edwards Deming, ironically, an American. Japanese companies like Toyota, Honda, and Nissan didn't just challenge Detroit's auto giants. They outmaneuvered them, out-innovated them, and flooded the US market with smaller, more fuel-efficient, and often more reliable cars. In consumer electronics, names like Sony with its iconic Walkman, Panasonic, Toshiba, and Sharp became global household names, synonymous with cutting-edge technology from VCRs to televisions to cameras. In semiconductors, Japanese firms like NEC, Hitachi, and Fujitsu mounted a devastating assault on American dominance, particularly in memory chips, leading to fears that the US was losing control of a technology fundamental to its future economic and military security. By the mid-1980s, Japan Inc. wasn't just an economic model, it was a global juggernaut. The yen was strong, Japanese tourists were buying up everything from Tiffany's to Rockefeller Center, and a palpable sense of anxiety, even outright fear, was gripping American industry and policymakers. Was the American century over before it had even truly run its course? As Japanese products flooded US markets and American industries like steel, auto manufacturing, and electronics screamed like their life depended on it, the US trade deficit with Japan ballooned to alarming levels. The overall US merchandise trade deficit was already exceeding $100 billion annually by the mid-1980s. In 1984, the US merchandise trade deficit with Japan hit nearly $37 billion, a colossal sum at the time, with the deficit in electronics alone surpassing $15 billion, representing a huge chunk of America's total trade deficit, which would reach $125 billion in 1985. This wasn't just an economic statistic. It was a political firestorm, amplified by corporate lobbying from giants like Caterpillar and IBM who argued the overvalued dollar was crippling them. American workers were losing jobs, factories were closing, and the narrative took hold. Japan wasn't playing fair. Accusations flew of Japanese protectionism, keeping its own markets closed while exploiting America's, and currency manipulation, with some arguing the yen was kept artificially weak to boost exports. The US Congress was seething. Protectionist sentiment exploded with calls for massive tariffs on Japanese goods and aggressive measures to level the playing field. Figures like Lee Iacocca, the charismatic head of Chrysler, became national heroes for railing against Japanese auto imports. The pressure on the Reagan administration, which had shifted its stance on dollar intervention following James A. Baker III's appointment as Treasury Secretary in January 1985, became unbearable. Washington found itself at a crossroads. Either succumb to a wave of self-destructive protectionist legislation that could trigger a global trade war, or find another way to blunt Japan's seemingly unstoppable economic offensive. They chose another way. A targeted, coordinated strike against the very engine of Japan's export miracle, the value of its currency. Though US pressure would also manifest through other means like voluntary export restraints, and later, the contentious US-Japan semiconductor agreements. The Plaza Accord ambush. September 22, 1985. The Plaza Hotel, New York City. Finance ministers and central bank governors from the world's 5 leading industrial economies, the G5, United States, Japan, West Germany, France, and the United Kingdom, gathered for what was publicly billed as a routine meeting. But behind closed doors, a geopolitical bombshell was being primed. The U.S. delegation, led by the formidable Treasury Secretary James Baker III, came with a clear, non-negotiable agenda: force an appreciation of the Japanese yen and the German Deutschmark against the U.S. dollar. The stated goal of the Plaza Accord was to reduce the massive U.S. trade deficit by making American exports cheaper and imports more expensive, thereby correcting global trade imbalances in an orderly fashion. But many analysts, then and now, argue the real underlying U.S. motive was far more strategic: to deliberately kneecap Japan's export-driven economy, to slow down its relentless rise, and to reassert American economic dominance. The Japanese delegation, led by Finance Minister Noboru Takeshita, found themselves under immense pressure. Interestingly, Takeshita was reportedly more forthcoming than expected, some accounts suggesting he indicated Japan could accept a yen rate up to 200 or even 190 to the dollar, partly to preempt more damaging unilateral U.S. trade actions. Japan also agreed to open its markets more and to boost spending at home. They gave in. The Plaza Accord was announced, and the G5 nations promised to take cooperative action to bring down the value of the dollar. How would they do it? By working together in currency markets. Basically, central banks planned to sell huge amounts of US dollars and buy lots of yen and Deutschmarks. The effect on the Japanese yen was fast and harsh. Before the accord, the yen traded at around 240, between 239 and 242 to the US dollar. In just 2 years, by late 1987, it had jumped to nearly 120, between 120 and 128 yen to the dollar. That's a shocking rise, meaning the yen was now worth twice as much against the dollar. Japanese exports, which had become much more expensive in the world market, suddenly stalled. The US got what it wanted. Japan's strong economy started to slow down. You see, the Plaza Accord didn't just make Japanese exports uncompetitive overnight. It unleashed a cascade of devastating, unforeseen, or perhaps, for some in Washington, foreseen consequences within Japan itself. Faced with a rapidly strengthening yen that was strangling its export sector and threatening a deep recession, the Bank of Japan, also navigating international commitments to stimulate domestic demand and fears that raising rates would further boost the yen, panicked. To counteract the deflationary pressure of indaka, the strong yen, the BOJ slashed interest rates repeatedly and dramatically, flooding the Japanese economy with cheap money, a move occurring alongside ongoing financial deregulation. From a discount rate of 5% at the end of 1985, it dropped 5 times to a then historic low of 2.5% by early 1987. The intention was to stimulate domestic demand to compensate for collapsing export revenues. The result? It fueled one of the most spectacular, most insane speculative asset bubbles in modern history. With borrowing costs at rock bottom and traditional export industries struggling, vast amounts of capital, both domestic and international, poured into Japanese stocks and real estate. The Nikkei stock index, which was around 13,113 in late 1985 when the Tokyo Stock Exchange total market capitalization was around $0.9 trillion, more than tripled, soaring to an all-time high of 38,915.87 by the end of 1989, at which point the total market capitalization reached an estimated $4.1 trillion. At one point, the value of the Tokyo Exchange reportedly exceeded that of the entire U.S. stock market. And real estate? It went beyond insane. Stories of tiny, plain-looking pieces of land in Tokyo selling for tens of millions of dollars became common. Golf club memberships were traded like stocks and sold for hundreds of thousands, even millions of dollars. The feeling of being rich was exciting. Japanese companies, full of cash from rising stock prices and easy loans, started buying famous American things like Rockefeller Center and Columbia Pictures. This made many Americans even more worried about a Japanese takeover. But all of this was built on shaky ground, cheap money and wild guessing in the markets. It was the result of the currency shock from the Plaza Accord mixed with Japan's own policy choices and financial situation. The Great Collapse. Then, like many feared, the bubble popped. Starting in early 1990, the Nikkei stock index began a scary and unstoppable fall. By August 1992, it dropped to around 14,000, more than 60% below its highest point, erasing trillions of dollars in paper wealth. The total value of all companies on the Tokyo Stock Exchange had hit around $4.1 trillion in late 1989. But by 1992, some reports showed that traded stocks had dropped to as low as $606 billion, a shocking loss in value. Real estate followed, with land prices crashing. Banks and companies were stuck with mountains of bad loans, backed by land that was now almost worthless. These bad debts were huge. By 1999, losses from clearing them reached around 54.7 trillion yen. The Japanese economy, once seen as unstoppable, crashed into a deep recession from February 1991 to October 1993. Then came a long, painful time of deflation, falling prices, low wages, and weak confidence in the economy. This period, called the Lost Decade, lasted more than 10 years. Many businesses were drowning in debt and had almost no customers. They became zombie companies, staying alive only because banks were too scared to let them fail. People stopped spending money. New ideas slowed down. The strong and proud Japan Inc. of the 1980s became a quiet, confused country trying to figure out what had gone so wrong. So how did Washington respond to this massive economic disaster hitting its close Pacific partner and rival? Publicly, U.S. leaders and Treasury officials said the Plaza Accord and its results were a necessary correction. They said it helped fix big trade problems and stopped worse laws that could have hurt global trade. They also claimed it made Japan start important changes in its economy. Most reports say the U.S. acted mainly out of worry for its own economy, things like trade deficits and losing in global markets. Experts like C. Fred Bergston, who led the Institute for International Economics, said the U.S. dollar had become too strong, and the accord helped protect world financial stability. Former U.S. Treasury officials, when looking back, often said they never meant to hurt Japan's economy. Their goal was to make trade fairer. Some even blamed Japan for letting the bubble grow so big and for reacting too slowly when its banks got into trouble. In public, few U.S. leaders admitted the accord might have acted like an economic weapon. Most didn't recognize how badly it damaged Japan. For many in the U.S., it was just seen as a big win, a way to take back control of the world economy. The view from Tokyo, however, was, and still is, more complicated, more painful, and full of regret. Some even felt betrayed. At the time, Japanese leaders like Finance Minister Takeshita, who worked to avoid worse U.S. trade laws and supported reforms like those later suggested by the Miyakawa Commission, said they were helping global teamwork by joining the Plaza Accord. But in the years that followed, many in Japan began to look back and feel uneasy. Some became quietly angry. Hiroshi Nakaso, a well-respected former deputy governor of the Bank of Japan, made a strong statement years later. "We didn't fully understand the long-term consequences of our response to the yen's appreciation. We fueled a bubble we couldn't control." He wasn't just saying they made a mistake. He was pointing to a time when Japan, under serious outside pressure and with its own policy missteps, may have lost control of its future. Did Japan's leaders in 1985 really know how bad the currency shock would be? Or were they, as some Japanese economists now say, pushed into the deal by the US, their top security partner, and ended up with an agreement that hurt them for years? That debate still goes on in Japan. Was it a painful but needed change, or was it a move by others to stop Japan from becoming a world leader? Many now believe it was the second one, though some point to countries like West Germany, which also faced currency changes after the Plaza Accord but avoided a major crisis. They say that different choices and stronger systems at home helped Germany avoid the same fate, so maybe Japan's collapse wasn't only due to outside pressure. 40 years after the Plaza Accord, 35 years after the bubble burst. Where is Japan now? The lost decade of the 1990s sadly turned into 2, then 3 lost decades. Japan is still one of the world's top economies, usually 3rd or 4th depending on how you measure it. But it's not the powerful country that once looked ready to pass the United States. Japan's GDP, total economic output, hit about $5.45 trillion in 1995, but has stayed between $4.5 and $4.9 trillion for most of the 2000s. Sometimes it went even lower. Meanwhile, the US economy soared, reaching more than $28 trillion by 2025. Japan still faces problems: very low inflation or even deflation, slow wage growth, a shrinking and aging population, which is a serious issue, and one of the world's biggest debts, now over 250% of its GDP, with central government debt around 260%. Many people now think with a deflation mindset. They wait to spend, thinking prices will fall. Companies play it safe, and the creative spark, once Japan's strength, has faded in many areas. There have been small recoveries in policies like Abenomics, but the energy and power of the 1970s and 80s now feel like a distant memory. Many experts believe Japan is stuck in never-ending, lost decades. Japan's dream of an economic empire lay shattered. Was it a U.S. takedown via the Plaza Accord and subsequent pressures like the Structural Impediments Initiative? Or Japan's own fatal errors in monetary policy and crisis management? 40 years on, the debate rages. As new powers rise in 2025, the chilling question remains: will America ever tolerate a true economic rival? What's your verdict? Drop your intel below.